Hi again. In this episode, we are going to answer the question, how is the minimum required distribution, RMD, calculated? Well, as you learn about this, I'm going to teach you how it's calculated, and I would recommend if you want to see an actual chart, you download the IRS publication 590, but I'll explain it to you here. But then I'm going to share with you why you are not going to be doing that. If you're smart, don't take the minimum. I would be taking almost the maximum required distribution. And people say, what? Here we go. So when you go to publication 590, it will actually show you a chart based upon how much the IRS feels like you should take out, because remember, their objective is to get the money out, the taxes over and done with sooner than later, and then they'll tax you again when you do die, because they've been planning on this tax revenue. So they do it based upon a life expectancy formula. Now, RMDs apply to qualified plans in general. This could be a traditional IRA or a SEP IRA, or it could also apply to simple IRAs, 401ks, 403bs. These are qualified plans. Now, qualified with who? The government, okay? With Uncle Sam, most traditional qualified plans, you got a tax break on the contribution money, the seed money. And then it accumulated tax deferred, and now it's their payday. They've been waiting. Let me just use this scenario. Let's say that you and I were going to go into a partnership, a business, but I say this, okay, you're gonna go into business and I'm your partner, and you're gonna do all the work. And you're gonna build this business up throughout your lifetime, and I get a third ownership in that business when you finally cash in and sell the business. And here's the deal. If you try to pay me off or buy me out early, I'm going to penalize you 10% on top of the third that I get of your business. But at the time that you want to sell, if you postpone and you don't sell the business and give me my third when I want it, I'm going to penalize you 50% on what you should have been giving me. Now, would you go into business with a partner like that? Now, people go, heavens no! And I go, I just described an IRA or 401k to you. See, Uncle Sam is your partner and they call all the shots. If you touch it before age 59 and a half, it's a 10% penalty. You can only put it in a certain dollar amount and so forth. But when you go to liquidate, if you don't withdraw or sell a portion of that when they want you to, it's a 50% penalty. Who wants a partner like that? But see, sometimes people don't realize this too late. And so they hit retirement and their well-meaning advisor, tax accountant says, oh, you don't need the money? Well, you don't want to pay 50% in penalty, so take the RMD, required minimum distribution. So how is that calculated? Well, let's say that at age 70 and a half, you want to avoid that 50% penalty. If you look at their chart between age 70 and 71, the life expectancy, now this is just in general, it's different for a female versus a male, but is 27.4 years on this chart. Now, this changes every few years because we live longer and so forth. So if that was 27.4 years, you would divide, let's say, your account balance, the previous December 31st. Over all your IRAs and 401ks. You have to add them all up together. What they were worth on December 31st of the previous year, you have to divide that. Let's say it's 100,000 or a million, doesn't matter. You divide it by 27.4, and that's the required minimum distribution. But guess what? It goes up the next year. See, at age 72, it's 25.6. At age 75, it's 22.9. So at age 76, it's 22. So now, can you see that the required minimum distribution, you have to divide by 22. So you have to take out more and more because your LE, your life expectancy, is fewer years. Do you know what it is as you start to get to be age 95 and people get concerned about outliving their money? At age 95, you have to divide it by 8 because your life expectancy is 8.6 years. Well, the fastest growing segment of American society today are those people reaching over age 100. You have to divide by 6. If you're 105, you have to divide by 4. You get up there to where you're 107, 108, 110 years old, guess what? You have to take out half. Because your life expectancy is 2 years. Do you see what they designed an RMD to do? They want that money out. And they want to get their tax revenue as soon as possible. And any money left over, they'll tax you again when you transfer it to your spouse or your non-spousal heirs. It's really the worst advice. People get duped into it because they think, oh, they're saving tax. No, you're not. You're compounding the problem and delaying the inevitable. I'm going to show you why. I go crazy when I hear a tax advisor say, oh, you want to save some tax? Just take the RMD. Well, that may only save you taxes in that one given year. When you look at the big picture, if they were to word it this way, oh, do you want to stretch out and pay taxes over the rest of your lifetime and end up paying maybe 5 times more? If they ask it that way, people say what? Because sometimes tax advice only looks at a single year and not the big picture. Again, we have to look at where taxes are going, because whenever I ask audiences, do you think future taxes are going to be lower, the same, or higher? Most people say higher. Well, then why do you want to keep postponing and taking out RMDs? Are you going to postpone and take it out later when we are all convinced they're higher? So when people would come to me with yet to be taxed IRAs and 401ks, I would always ask, are you planning your retirement or Uncle Sam's? Because when you go to retire, Uncle Sam is sitting there and taking a bigger and bigger piece of the American taxpayer's pie. And we know the government's appetite for spending. And more and more, we realize that taxes are going to be climbing and creeping up. There are periods where it's lower. And so you need to use strategies. I've used the $1 Million Dash in other episodes, but when we talk about these phases of retirement that maybe you've watched another episode, the contribution phase where we contribute money, the accumulation where it earns or grows, the distribution phase when you go to retire, and then the transfer phase. So many people put money in taxed as earned investments, and they take after-tax money, they pay tax every year on their interest and dividends. Any gains are taxed, and when you die, it's taxed. And that's the most common way people save. Many people take after-tax money and buy a tax-deferred annuity. But then when they take it out, it's taxed, and it's taxed LIFO, last in, first out. There's only one green circle. So a lot of people think, oh, I have an IRA, I have a 401k. I get the tax-free contribution. I am able to use tax advantage seed money. It accumulates tax deferred, but then when I retire, I pay the tax, and they thought they were going to be in a lower bracket here, and they're not, and then it's taxed again. And what happens is they get duped into taking RMDs. Step in the right direction might be a Roth. You pay tax on the seed, it grows tax-free, you can take it out tax-free. But my favorite is the MFTA, Maximum Funded Tax Advantage, Section 101A alternative that I teach about in other episodes. And 3 green circles will way outperform 2 green circles from a net spendable income and tax standpoint. I like 4 green circles, and that's why I teach asset optimization plans where I get the tax deductions on the front end indirectly, and then I accumulate access and transfer my money tax-free, but it blossoms and transfers. And I can prove all day long that 4 green circles outperforms 3 green circles and gives you 50 to 100% more. And 3 green circles is 50 to 100% better than an IRA or 401k. So I have a little ditty that goes, good, better, best. Never let it rest. Never let it rest till good gets better and better gets best. If you're trapped in an IRA or 401k, you need to get the money out, because these 2 things are certain. Money will never be worth more than it is today because of inflation. You want to stay ahead of that, and so you want to pay taxes in today's dollars, not tomorrow's dollars, okay? Your current tax bracket will likely be the lowest bracket you will ever be in. So don't get caught up in taking the required minimum distribution and looking at the calculation, oh, let's just take out this. I would probably take out the maximum in a certain tax threshold. If you have 30, 40, or 50,000 of room to the current tax thresholds in a given year where you will not go up any higher in taxes federally, like from 22 to 25% or from 25 to 28%, I tell people, take the money out. Get the taxes over and done with. You will be glad you did instead of trying to postpone. And I'm going to share a quick story about somebody who I told them to do that and they did not take my advice and they kicked themselves. So I had a couple that they had about $57,000 that they could withdraw out of an IRA or 401k where it wouldn't take them to any higher tax rate. And I said, you know what, if I were you, I would take that out. And their accountant says, what are you telling them to do? And they got scared, and so they put it off. Next year, the market dived, and instead of paying an extra 3% in tax, let's say, that was like $1,700, they ended up losing 30 to 40%. They lost nearly $100,000 because they didn't get it out. They were involved emotionally. I don't want to pay the tax. And they wish they could retroactively go back and take out way more than the required minimum distribution. I had one gentleman, he was so smart at age 70 and a half, he didn't need the money. He ignored his CPA. He had $500,000. And instead of taking out the required minimum, he came to a seminar and he goes, Doug, you hit the nail right on the head. He came in and he says, I'm not even going to spread it out over 5 years. I'm in the highest bracket. He took out the entire $500,000, paid tax of 40%. He was in the highest bracket, $200,000. He took the remaining $300,000 and put it into a max funded insurance contract to maximize what he left behind because he wanted to have it blossom and transfer tax free. That $300,000 after paying tax on his IRAs and 401ks blossomed to $1.5 million tax free. That endowed his family bank, his children and grandchildren, with far more than a measly IRA or 401k would have left behind because it would have been subject to tax had he done that. See, getting the taxes over and done with sooner than later is better than just what is the required minimum distribution so I can pay the least amount. You will pay the most if you buy into that concept. So watch this video to understand how this all comes together and how to rethink your thinking.